Welcome. I'm Catherine Magana here with Gregg Carroll and Vince Stefano, where we're here to provide you insights about the markets, planning, and much more. Today is May 22nd, and over the last week, we've seen a little bit of market movement, especially actually as of yesterday. So we'll give you a recap as of yesterday's close, which was May 21st of 2025. The Dow Jones for the year is down 1.61%, and that's down about only about 0.5% from last week, so not a big move. And the NASDAQ year-to-date is down 2.27%, and from last week, that's about a little less than 1.5% move. And then the S&P 500 year-to-date, as of yesterday's close, was 0.63%, and that's a shift from last week to this week about 0.82%. So not a lot of movement from last week to this week, but it feels a lot worse because yesterday was a big down day. And so here we are. We went from tariffs to taxes to budgets and debts, and it seems like there's just been a lot of headlines and a lot of information out there. And obviously one of the main things right now we're looking at is kind of bond yields and rates, and those have shifted a little bit. It looks like the 10-year right now is, I think that was a little over 4.6%, and we were seeing the 30-year over 5.1%. So kind of a big change in the week. But I think the main thing that we're hearing a lot about is the debt, which we've talked about in the past. Like, we knew this is something that's been out there. And so it's interesting. I said, well, let's see, where are we at with the U.S. national debt? And as of May 7th, the Joint Economic Committee came out with a report. As of May 5th, they came out with a report. It was released May 7th. And the total gross national debt is $36.21 trillion. And that is $1.66 trillion higher than it was a year ago. And relative to 5 years ago, it's $11.15 trillion higher. So obviously, as we're seeing some of the tax reform and budgets and everything, I think obviously this is definitely something that's been on the forefront on conversations recently.
Yeah, I think the reason the bond market kind of spiked yesterday was that the House passed the big, new, beautiful bill.
Yes.
And, there's definitely a lot of, tax cuts, so there's concern there's going to be a lot less revenue to help pay for this high debt. So it's going to be interesting. But when you look at where the markets are at today, it's been a volatile year, especially since Liberation Day in early April. I mean, the S&P is, 4 or 5% from an all-time high. 10-year bond at 4.6 is still in this range between 4.25 and 4 3/4. Gold's a couple percent off all-time high. Bitcoin's at an all-time high today. So I was listening to a report yesterday, I think it was, about fairly large companies, mid-sized companies, talking about what they're seeing in the economy, and they're saying things are pretty good. Mm-hmm. Unemployment is still very low. So until unemployment changes, I mean, we're going to see this jockeying around and the volatility continuing as these tariff negotiations go on, because there's a lot of work left to do there. We're going to see a lot more volatility.
And I think that's what hit the market yesterday. The market was, relatively nervous about, tariffs, interest rates, and Iran nuclear negotiations. So from the tariff standpoint, they've been concerned about this for a few months. We've been talking about it. The Trump administration has put a 90-day pause so that they can negotiate with a number of countries. They've indicated that letters have been sent to countries abroad outlining the U.S. stance. And now I guess we're just waiting for an answer from these countries with their proposals or counter proposals. And so far, nothing in tariffs has been canceled. So it's wait and see, wait and see, wait and see. So that was number one. Interest rates, you guys just mentioned that. Yesterday was concerning because the 20-year bond auction came in very poor. Catherine, you talked about where the interest rates kind of settled out, and anytime a 30-year gets above 5%, the stock market gets a little nervous. And a lot of that is because they're thinking that tariffs may cause a slowdown in global growth. So the bond market looked at that. And then I saw a news squib where the U.S. intelligence agencies were saying that there might be an imminent attack by Israel on Iran's nuclear facility. So that drove the market down. Now, I didn't see anything happen on that or anything, but that was part of why I think we saw some real volatility in the market yesterday. So what happened? Well, we got the tax and reconciliation bill passed. Now it goes to the Senate for amendments.
Because you don't think that when it's all said and done, it's still going to take some time, and there might be some revisions. I mean, the reality is when we see these, like when it moving along, we get happy, and we get excited this is going to happen. But the reality is there's still a process.
And I don't know what amendments the Senate's going to put on, or when the Senate's going to actually vote on this thing. But I think overall, long term, this could be positive. Number one, you get tax cuts. No tax on tips or overtime. You eliminate burdensome business regulations, and you rid the government a lot of waste, fraud, and abuse. And I think that's all very good for the market. I think that's good for the economy, and it's good for the debt that you had mentioned. So all of that, I think, is positive. And I think another very important thing that we kind of forget about is when Trump went to the Middle East, he secured trillions of dollars of potential investment from Middle Eastern sovereign debt fund, or sovereign wealth funds to come into the United States. And they're talking about earmarking a lot of this money for AI, for chips, for software development, for cybersecurity, and nuclear. Because with the advent of more hyperscalers and data centers, they need a secure form of energy, and nuclear provides that. So, I think you're going to see some real interesting things happen within the technology space over the next few years as all of this money starts to come into the market and flow into, different types of stocks. Not going to happen overnight, but it does put an upward bias on the market over the next few years. And again, I'm going to reiterate this and say to all people who are listening, do not sit this out. Don't sit in low yielding money funds or low yielding CDs that lock you in for a long period of time. The stock market is the biggest wealth creator in history.
I think you have a long-term perspective. Yes. I mean, if you're trying to time this, you cannot time this market.
But I'm just saying, get in the market, invest in very good, high-quality growth companies that have, very unique products or services selling to an expanding market. And that's going to help not only the economy, but also the companies that you invest in. So again, don't sit this out. That's my 2
cents.
That's my 2 cents.
There you go. So looking at interest rates, going back to that, I was looking at the 1 year. We kind of look at either CDs or treasuries to see, and right now CDs are a little higher than treasuries. The 1 year as of this morning is 4.25%. So we've seen a little bit of an increase there. And then the 2 year right now is 4.15 versus treasuries are a little under 4. I think it's 3.99. And so, once again, we've seen a slight shift with some of those shorter-term fixed income, and then obviously, we don't expect you to keep money there forever, but that's obviously some investors have part of their money there for liquidity needs. And then, as we were talking about interest rates, and I know Vince and I were kind of sharing yesterday, like, where are the mortgage rates going to be now? And so, looking at that this morning, it looks like the average 30-year fixed rate is up 5 basis points. So it's now at 6.86%, and the 15-year fixed rate rose 9 basis points, and now it's at 6.01. So still not the 8%, which was high, but I think we were seeing it come down a little bit, and so we're seeing those shift up a little bit as of yesterday as well.
Yeah, it's going to be interesting to see how the tariffs, increase the cost of building new houses.
Yeah.
That's going to be a problem because we are so short on supply, and with the rates being so, elevated, people just aren't willing to move and still give up. A lot of people still have those really terrific mortgages, as low as 2.5%, and below 5%. It's hard to take on a 7% mortgage.
Yeah, unless you are downsizing or moving out of state. I mean, there's a certain, or if you have an property you inherited and you want to sell, but there's certain circumstances. But yes, a lot of it, it's not the low rates that we had a few years ago. And then touching on a little bit of the kind of the tax bill, the beautiful tax bill that just got
Big,
the
beautiful.
big beautiful tax bill that got passed. Once again, we don't want to share too much because it hasn't been approved, but just some of the headlines and things that we're looking at is changes to SALT, which is the state and local tax deduction, and it looks like they're looking at the cap at $40,000 and phasing out until if you're over $500,000 in income.
They never had an income restriction on that before, have they?
You know what? I'm not sure. Well, I knew it was the $10,000
Right.
That got changed, but to bring that up to $40,000, I mean that's
Yeah,
pretty significant.
that's a big deal.
There, and then it looks like the just looking at some of the different deductions, and so just I think there's still some room for improvement. But
Well, no tax on tips,
Yeah.
no tax on no tax on car loan interest. They're doing a larger child tax credit. I mean, there's a lot of different things in there that will appeal to a broad sector of the economy, I believe.
But you have to buy an American car to get the no interest.
Interest.
So you have to.
Okay,
It has to be an
interesting.
American-made car, and if you buy it, you don't pay interest.
Is that for new cars after this passes, or what if you're already paying on an American
Dude, I
car?
don't know. I have no idea.
Where's Rachel when we need her?
I don't know. I don't know anything about that. That hasn't been spelled out yet. But I think that they're looking to really help American industries with everything they're doing, and I think again it's a very positive bias for the stock market, and
Yeah, and we haven't even gotten to a lot of the deregulation.
No,
I mean, we've
not
done
yet.
the tariffs, we're in the middle of the tariffs, and now we're trying to do the tax cuts, and then there's deregulation to follow after that. So, Vince, to your point, I mean, there's a lot of positive potential momentum. coming in the market.
I like the fact that if they can get these business regulations, just eliminate so much of the red tape that has hindered businesses over the last 4 to 5 years. I think that's going to be a real positive for the market, and it's going to be positive for the economy because more businesses could be started, more people will be employed. You'll get you'll expand the tax base, you'll reduce the deficit, and all of that is good. So, and with that, hopefully interest rates start coming down, and real estate will be much more affordable for everyone.
So I thought I'd share a little bit planning, and so I found an article from Think Advisor, and it was talking about there's 6 secrets that clients keep from their advisors. And so I know our clients don't keep these secrets from us, but it was just kind of interesting. And so the first one is debt loads. So obviously, if you have debt, what I find is a lot of times clients, they have credit cards and they pay it off. I mean, I don't really see a pretty large debt load, but there could be some debt out there, and that's definitely something you don't want to. You want to have that discussion and make sure that's getting paid off. There's also, the second one was personal loans. So I was saying that sometimes there's family loans or certain things that are done and, not coming up and sharing that, but that is part of your plan if you are giving money and it's a loan, and there's certain requirements for that, but just making sure that that's something that you're sharing with us. And then the life events, which we pretty much hear about, but those are usually change of job, a death of a family member, a divorce, and those major life-changing events do impact your financial plan. So I do feel like we hear about a lot of that from our clients, but I guess that's something that that doesn't get shared a lot.
I've had a few instances where clients have either refinanced the house to get more money out of it, or taken on some consolidated loan, and where it kind of slips out in conversations, when you're asking them, and you've asked them these questions multiple times, but you're doing a review and then things come up and they say something, you're like, well, tell me more about that. You didn't tell me about that before.
Yeah.
It's kind of important.
Or you may have sometimes I've had clients where like, well, my son is starting this business and I decided to give them some money, but they don't look at it as a loan, but but they expect the money back, but it's just one of those things. Having a family and things do come up periodically.
Mm-hmm.
Another one is past mistakes. So I guess a lot of clients don't like to talk about their past mistakes and financial mistakes. A lot of times when we have new clients, we're really trying to figure out kind of what they've done in the past and some things in their history, and so we do kind of ask a lot of questions and want to get to know them. But our current clients hopefully don't have a lot of mistakes because they're working with us, but we shall see. And then partner, obviously having, being confident with your partner and some of the things that you're talking about financially and making sure sometimes there's spending habits or things that might be a little different and not really sharing those differences. And I think that tends to usually come up when you're looking at budget and expenses. And so it's just something that as you're continuing to work with us, please make sure you share if there's any changes in patterns or lives. And that's what we're here for, is to make sure your financial plan and your investments are in order. So I know we covered a lot. There's still a lot going on in the markets and in the world, and every day is a new day. But we do appreciate you joining us today, and hopefully we have some positive news for you next week. So until then, thank you.
Bye.
Bye. And Memorial Day weekend.
Yes.
Got the day off on Monday.
There we go.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.